Hello everyone. The second video in this series is about non-banking institutions. In order to understand personal finance, it is important to get a basic foundation in the types of institutions, the roles they play, and which institution is best suited for which specific activity. A financial institution is a company or institution that deals with financial and monetary transactions. There are two types of financial institutions: banking institutions and non-banking institutions. In this video, we will be focusing on non-banking institutions. The basic difference between the two is that non-banking institutions are not allowed to issue checks or demand drafts like banking institutions. There are four types of non-banking institutions. They are investment banks, brokerage firms, insurance companies, and mortgage companies. Investment banks specialize in managing complex financial transactions for corporate clients. An example of an investment bank is J.P. Morgan. There are three main functions of an investment bank. Number one, financial advisor. Investment banks provide strategic advice to institutional investors and evaluate short and long-term opportunities and challenges. Investment banks can help companies through IPOs. An IPO is the abbreviation for initial public offering. This happens when a company becomes public and starts offering shares. Other than IPOs, investment banks can advise corporations on other aspects of financing, such as alternative ways of raising capital. Number two, mergers. Banks also help estimate the value of potential mergers and help negotiate a fair price. In addition, banks help structure and facilitate the merger in order to make sure the deals occur without problems. Number three, research. Another major function of investment banks is research. Investment banks review companies and write reports about buying, selling, and holding shares. Brokerage firms are middlemen who connect buyers and sellers to facilitate an investment transaction. An example of a brokerage firm is Charles Schwab. Brokerage firms charge a small transaction fee when transactions are completed. The transactions can be carried out online via apps or websites or at physical offices. There are three types of brokerage firms: full-service brokerage, discount brokerage, and robo-advisors. Number one, full-service brokerage. Full-service brokerage firms provide financial advisors who offer advice, manage all investment decisions, and provide ongoing support. Number two, discount brokerage. Discount brokerage firms provide online platforms for self-directed investors to make their own decisions for a very small or sometimes free commission. Robo-advisors. Robo-advisors is an automated investment advisory carried out by algorithms with minimal human intervention. Firms receive commissions in two types of way. They either get a flat fee or a percentage of the transaction amount. A flat fee is a fixed amount paid irrespective of the size of the transaction. The other payment method received is a percentage of the transaction amount. For example, if the transaction amount is $10 million and the percentage paid to the firm is 5%, the firm will receive an amount of $50,000. Insurance companies protect their customers against risks. An example of an insurance company is United Healthcare. In order to protect their assets, customers pay premiums, which the insurance company invests and pays out to the customer when they make a claim for the insured events. There are several types of insurance, as a person can insure against any asset. A few of the most common ones are car insurance, home insurance, life insurance, health insurance, liability insurance, and pet insurance. Mortgage companies originate funds or mortgages for residential or commercial property. An example of a mortgage company is Wells Fargo Home Mortgage. There are four main factors affecting whether you're given a mortgage or not. Number one, credit score. A credit score is a number given to a consumer after analyzing the consumer's credit history. A credit history can include the number of open accounts, total level of debt, and repayment history. It shows the credit worthiness of the customer. The score is a number from 300 to 850. The higher the score, the more chances the consumer has of borrowing money or receiving a mortgage. Number two, the size of a down payment. A down payment is the amount of money paid right away in a financial transaction. The higher the down payment, the less the buyer needs to borrow to complete the transaction from a mortgage company. Number 3, liquid assets. Liquid assets are assets that can be easily exchanged for cash. While all assets can be converted to cash, liquid assets are those which can be sold in a short amount of time and won't take on a loss while being sold. A customer has better creditworthiness if he or she is in possession of many liquid assets. Number 4, debt-to-income ratio. The debt-to-income ratio measures the percentage of income that goes towards paying monthly debts. This ratio is used by lenders to determine a customer's borrowing risk. A DTI of 43% is generally the highest percentage a borrower can have and still be eligible for a mortgage. However, normally lenders prefer customers whose ratios are less than 36%. There are 7 types of lenders. Number 1, retail lender. Retail lenders lend money to individuals or retail customers. Banks and credit unions are examples of retail lenders. Personal loans, credit cards, and mortgages are examples of products that are offered by retail lenders. Number 2, direct lenders. A direct lender is a financial institution or private entity that provides the loan for a mortgage. Some direct lenders are private companies that deal specifically with financing mortgage loans for the general public. Number 3, portfolio lenders. Portfolio lenders offer mortgages directly and don't go through financial institutions or large agencies such as Fannie Mae and Freddie Mac. Number 4, correspondent lender. A correspondent lender is a lender that originates, underwrites, and funds a mortgage using their name. Later, they sell the loan to a mortgage lender who becomes the loan servicer and becomes in charge of collecting monthly payments. Number 5, warehouse lenders. Warehouse lenders provide loans or funds to borrowers without using their own capital. Number 6, hard money lenders. Hard money lenders are private investors or companies that deal with a specific type of lending. A consumer won't find hard money loan options at banks. Number 7, wholesale lenders. Wholesale lenders offer loans from banks or institutions, however, don't directly deal with consumers. Lenders offer their money to a third party, and then the money turns into loans that are given to the borrowers. Usually the third party is a mortgage broker, credit union, or bank. Thank you for watching, and I hope this has been an informative video. In the description box below, there is a link for a Quizlet which will help test you on the different types of non-banking institutions. Comment down below if you have any suggestions or questions, and click the like and subscribe button. See you next time.